That's what it was. If you were a single B bondholder and you wanted to sell your bonds because you're afraid, you would have had to get a big haircut. And we're going to find out. I mean, think about what that means. Right before that, single Bs were around 5. I mean, people knew these were coming. Let's look at, yeah, basically before COVID became or Corona became a household name, single B bonds were trading at 3.5 spread. Suddenly, boom, they went up to 11. I'm going to show you how much money you would have lost if you had to liquidate your single B positions when we go into valuation of bonds. So all the not all the bonds are treasury bonds. People actually take those risks. Suppose these days you want to take that risk, and typically individual junk bond issues. Junk means anything less than investment grade, and typically only double B and single B have some liquidity, because if you're even triple C, C stands for crap. Okay. Uh, in fact, we can look at it. I mean, single B is 3%. Let's see the jump in the spread when it is triple C. It goes from 3 to 770. It's a big jump. C really means you're in trouble. Okay. The likelihood of default, even if not just default, ability to service the loan is in doubt. That's what C means. And I'm going to talk about one more type of bond that's common. Convertible bonds. You guys know what these are? Have you heard of them? What do you think they are? Exactly. It basically says, let's say I issued $1 billion worth of bonds, and let's say the face value is 1,000. So there are a million of these things, and my stock is currently trading at $100, let's say. And I say, okay, you can convert each bond with a face value of 1,000 into 5 shares. Okay, so effective conversion price is basically 200. It's essentially an out of money call option, right? If the stock goes above 200, it would be advantageous for you uh, to convert it into that. Especially companies that are startups, they issue bonds like these. Convertibles for established companies are more common in Europe, especially in East Asia. The Japanese, Korean, and Chinese love the convertible bonds. They're very common. The benefit to the company is that conversion option is very valuable. Okay, I'll give you an example. Uh, when 2008 crash happened, as you know, we had two major investment banks that went down, Bear Stearns and Merrill Lynch. AIG was in teeters anyway. Even Goldman, that kind of came unscathed out of that, because if you guys can find it, watch the movie called Margin Call. Okay, they don't say it, but I know from my friends in the market that company that talking about was Goldman Sachs. Goldman Sachs dumped all these bad deals into their own clients. They came relatively unscathed, but had AIG not been saved by the Treasury, even Goldman Sachs would have been in trouble. So they and getting financing for the existing positions, even if they weren't that bad, was a difficult thing to do those days. Nobody wanted to take risk. And guess who they went to? They went to Warren Buffett. And they told Warren Buffett, okay, we're going to issue you a preferred stock, which is like a bond, but there is no set maturity, but it is convertible to Goldman shares. And those days, Goldman stock was trading around $100. The conversion price was 160, and Warren Buffett made a killing out of that. And the yield on those before the conversion option was 10% to begin with. So he was guaranteed to make 10% as long as Goldman was alive, but he also had the option to convert it at 160. And he, within, before June of 2009, he converted them all and made a killing out of it. Huh? I don't remember. I mean, this was what, 70? It was way over 200. And plus, he got the 10% in the meantime. I mean, he basically lent them money and he made 10% a year on that. Plus, he got the upside on the conversion. But if you knew anything about the investment banks those days, as long as as long as the AIG was going to be safe, Goldman was not at risk. So to him, Goldman was a value company in that sense. The market price of Goldman was too depressed because everybody was scared. In fact, it was so bad. There were these double A rated mortgage-backed securities, and these were senior tranches in pools. Normally, even in the worst case scenario, where underlying default rate is 50%, and the underlying collateral is going to lose 50% of its value, the senior tranches would not lose more than 5 or 10%. Okay, these things started trading at 40, 50 cents on the dollar, but the real price probably should have been 90, 95 cents. And smart people actually grabbed a lot of those at that point. That's why those yields went up to 11. Those spreads went up to 11% on single B. People just go flight to safety. Okay, the first thing they want to do, I don't want to take any risk. I don't want to be seen taking as risk. So they just get out. They worry about it later. That's pretty much what they did. Convertibles typically have zero or very low coupon rates. I mean, I could be a single B company. As you can see right now, I'm supposed to pay treasuries +3. So that's close to 8% right now, right? Well, I don't want to pay 8%. So I'm going to issue a convertible. I'm going to have a coupon rate of 1 or 2, if possible 0. But since that conversion option has a lot of value for the investors, they allow you to do that. I mean, you could basically issue those at par. You're basically telling your bondholders, you get the benefit from our upside. But until we actually get to be a better company, we don't want to pay high interest. That's what convertible bond does. It's basically a hybrid security between equity and bond. When the stock prices are low, it acts more like a bond because conversion is not that likely. When stock prices are high, it acts more like equity. Now, let's think about the valuation. I did give you guys the template, right? That's what I remember. Let me see. Yeah, bond pricing template. Okay. I mean, this has the forward and stuff too, but this is a simple template. Uh, let's go back to that uh, spreads going from 3% to 11%, or 3.5 to 11. And let's look at the treasury rates those days. So let's get the number from those days. The Dow drops 600 points. That's basically end of 2019. And treasuries were around 175 by March, or let's look at here. They were about 0.75. Everybody wanted to buy the treasury bonds. They're a lot more secure, right?